reading on the Russell is effectively red at the moment. Continuation of where we were, breaking under that RSI, breaking under that 20-day, continuation on the negative side on that MACD. So, it's going to be a tricky couple of days, possibly a couple of weeks. We're starting to see convergence again on the MFI, the RSI, and or forgive me, the 200, the 50, and the uh, 20 EMA. And typically, when that happens, we see some sort of directional move. And at the moment, as I've said before, there is a lot of bearish statements coming out of the Wall Street institutions this week. We saw Evercore make a projection of 7% to 15% downside for the S&P 500, which is pretty sizable. But that said, you saw similar projections from Morgan Stanley and as well from Deutsche Bank. Now, as I've noted, I think the markets are not really going to be necessarily aligned with overall questions about the economy. I do not firmly believe anymore that the U.S. economy is really what the U.S. market is actually forecasting. Again, the expectation was that the market was supposed to reflect economic conditions 6 to 12 months out, but this is an inverse chart of the Chicago Economic Conditions Index, and these are all measurements. This chart upside down, these are all measurements of credit risk and leverage in the system. And funny enough, since COVID, it basically looks exactly like the S&P 500. So I take all of that with a grain of salt when I see the ongoing projection that there is concerns about the underlying economy, because I go back to COVID where they printed every single dollar possible and the market went up while the economy was effectively shut down. We've seen the S&P 500 go higher in the last couple of months while economic activity has not been very robust in terms of those core underlyings. And I just always go back to something called Econ Pie. If you have not seen this before, hey, check it out. Here is your leading indicator still sitting in the expansion quad. Here is your MOC, mean of the coordinates, hovering between recovery and expansion. This has all of those key indicators that people are always paying attention to, the leading indicators and the lagging indicators. And what's so interesting about this is our current business cycle. We started back in Q1 when we were in major contraction quad. We moved through the recovery. We started to move into expansion, and then all hell broke loose starting in Q2 of 2022 when we started to inject a lot of capital into the system in continuation of quantitative support for the financial system. It has just been spinning around like this for the better part of 2.5 years. And resultantly, as we look at this, the ongoing concern is eventually we're going to get into decline and move into contraction. But the way that liquidity support remains ample by the Federal Reserve, and by the way that we see that level of support from the Treasury Department with the issuance of T-bills, well, here we are, still expanding, still growing together. Isn't it great? All right, so I need to pull up one quick thing real quick. I hope everybody is doing well today. See who we have in the chat hanging out. We got Guatemala, we got Rio. Good to see you guys. We're going to be doing some focus today on the overall fundamentals of stocks in our TheoTRADE mastermind today. Silver ratio way out of whack too, and it will remain so for the foreseeable future. Keep in mind that gold has been a real true reflection of global liquidity and expanding capital, and you have a significant amount of buying at that institutional central bank level over the last couple of years. Silver, more of an industrial player as well, so that is what it is. Ed Mines, good to see you. Clown Face and Rog Bro, good to see you. It is morning here, isn't it? It's 11:30. I've been up since about 5, so I feel like it's like late in the day and it's time to wrap it up. All right, so key thing to keep in mind over the next 24 hours, we are watching this under that 20-day moving average, and our FNGD has now moved back above the 20-day moving average, which is a little bit concerning. But we will just keep monitoring this, and we will see whether or not there is some economic data or some economic event that can push us higher. If we get above that 50-day moving average, that is where I'm going to urge extreme caution about the state of the S&P 500. And if we move above that line, that is where I start to short directly. Absolutely 100% of the time, be greedy while others are fearful. All right. So looking at the FinViz and looking at our charts and screeners and understanding the current status of momentum, what is breaking out and what is breaking down. We haven't been paying a ton of attention to the individual sector side, but I do think it is important to do that and to do a little bit of analysis of what's actually happening in the S&P 500 at this point, because we have a large number of sectors that are breaking down. And as a result of that, you're not seeing, even though there are more stocks breaking down than breaking out, you might not see it simply because there is higher market capitalization for the stocks that are still holding on. So right now, if we look across everything, a good example of this would just simply be, I don't know, let's just pick communication stocks. So if we look at the number of S&P 500 stocks that are up on the month and up on the week, let's customize this a little bit. And we're going to only focus on the COM. Got two, and Meta and Electronic Arts are in holding the line right now. Go to the other side of this, look at what's down, up and down 5%. You're going to be not too shocked by this, right? So you got two and you got two, and that's just the S&P 500. Well, what if you take it back now and you look at the Russell? Because this is where you're going to really see the weakness. 20 stocks on the Russell. And if we go back to the upside of this, where are we? 5, 20 against 8. So what's interesting about this, right, is that you have Meta holding things up, but you have this weak underbelly in the Russell 2000. And that's the key thing that we have to watch first, because if the Russell really starts to sell off, the question is, how does that impact the broader S&P 500? And how will that impact overall stocks over the next, say, 3 to 6 weeks? Now, I'm looking at this right now, and we're seeing weakness in COM, but once again, the XLK or XL, what is it? The XLC is still hovering above its 20-day moving average. So it's interesting because, as I've noted, you have more stocks on the Russell breaking down than breaking out, but on the S&P, things remain strong and still above that key moving average, again, because of the weight of Meta, which is the largest part of that ETF, 20% weight of that ETF, and maintaining that strength, despite the fact that other communication stocks are really breaking down in this environment. In addition to this, if you look at technology, it's the same thing. And that's what's very kind of challenging when people are trying to really wrap their head around when I'm talking about, when I'm saying momentum for an entire sector. And I'm not just talking about the S&P 500, because if we just did S&P 500, once again, stocks that are up in tech and up 5%. And remember, this is the poor man's way of doing it. I'm not bringing in beta coefficients, and I'm not fully analyzing each individual sector on the same exact metrics. It's a lot of math, but you got 9 in this situation. And interestingly enough, every one of these should be over 1 for a beta. They're not, right? So not all technology stocks are the same. You have 3 stocks that actually have a lower beta than the S&P 500, which is pretty interesting to see. But you've got 9 up, and 31 down. Okay, so how is it that the XLK is still holding above its 20-day? Because the weight of the index is still in Microsoft and Nvidia and Apple and Broadcom and Oracle and Palantir. And Palantir will likely be a higher percentage of these holdings in the future. But if you look at momentum and you look at it and you analyze it from the Russell, well, that's where it really gets ugly very quickly. 97 and a lot of software application stocks. And what's important to note about this, particularly software infrastructure and software applications, and right here, look how many of these names are unprofitable, right? Look how many of these names don't generate a profit. These are all zombie stocks, and they're all names that you likely know. So you start with SIVA, you start with Bakkt Holdings, which is a crypto name, BTL, PDR, CEAI, Ambarella, we know that, Asana selling off despite all of the big insider buying that we've witnessed. These are all zombie stocks. These are all companies that just are not generating a profit for companies. Yet, when momentum is strong in the market, these stocks tend to be holding up. Well, technology as an overall sector has been negative going back to, I believe, last Thursday, right? So last Thursday, the 29th, where we switched over. Stocks breaking out. Again, this all goes back to that academic report that I talked about, the Henning report. This is just a simple way of measuring 15 names. And once again, you have a lot of unprofitable companies. So it's just important to keep this in mind, even though, right, even though you might see that the XLK is holding up, look at the underbelly. Look at what is happening to a lot of these other names, particularly in the software application space and particularly in the software technology space, because those are the companies that people are selling based on the news around the jobs report. And as momentum may be breaking down in the Russell 2000, anyone who's trading that sector from a momentum perspective will take aim at a lot of these smaller names because, once again, there's not going to be any significant institutional support, and there's not going to be a lot of ETFs that are going to be providing that passive support as well. The top of the S&P 500 is a much different animal than the Russell. It's a completely different index, and it is impacted very, very differently. There's not a lot of passive investing. There's not a lot of funds stepping in and buying the stock. There's not a lot of activist interest in these names compared to the names that are in the S&P 500. And these names are obviously more impacted by local U.S. policy than the international names that are subject to significant amount of capital flows, and on top of that, a lot more exposure to international currency markets, which are obviously impact their earnings expectations. All right, so that's just kind of my warning, just letting you know, kind of just hanging out, trying to get a good sense of what actually is going on here. And we've just seen weakness, right? We're seeing weakness. The question is, how much does this weakness build? Technology weak, industrials are weak, financials are weak. Very important to keep an eye on the KRE, which has continued to just hover around that in that no man's land of the 50 and the 20. As I've said, when it comes to these bigger issues, things like the KRE, just focus on the moving averages. And if you break above them, look to trade to the upside. If you break below that 50, well, that's where we could have some serious issues with our regional banking stocks. And I've raised some concerns around the regional banks just because of the lack of policy support at the moment. But do keep in mind that if we get down into these oversold levels, which we have seen at various points, particularly with RSI and MFI, you're just looking for a short-term bounce for an opportunity to make a trade. Very contrarian, but again, the whole point here is you keep a tight stop and you look for upside as it emerges. One of the last things I just want to point out is when we look at the analysis of all of those sectors or all of these stocks, this is a really important component of this. I'm obviously measuring it, and I'm obviously writing about it every single day. I'm obviously pulling up this every morning and I'm analyzing the number of stocks that are breaking out versus the number of stocks that are breaking down. One of the biggest dirty secrets that I don't think a lot of people have really caught on to yet is the nature of a short squeeze. Now, we have seen in the past people, particularly here, right, who have said, yeah, this is all setting up really uniquely for a short squeeze. And this happened back on March 12th. I don't know what it was that they saw. They might have seen something in option flow. They might have seen something just in, buying pressure, things along those lines. What I or not buying pressure in terms of like near term RSI or MFI. 30-day MFI is always good. So is the 30-minute RSI and 30-minute MFI, both in oversold conditions, can present itself for a very good opportunity. But what I'm specifically looking at is a situation where there are absolutely no stocks breaking out. There are no stocks up 5% and up on the month. There's no momentum, right? Cheap way of measuring it, but there's no momentum, zero. And what that signals is that there is a lack of buying interest at the time. So this is what happened back here on March 12th. And I will note that this signal that I've walked through multiple times, pattern that I've walked through multiple times, I've called this the 1% pattern. What this happens here is you see these breakdowns transpire. Remember, a lot of algos might shut off under that 50-day moving average. A lot of technical traders might just go golfing. And you just see a burn of selling lower over a period of time. Eventually what happens is you hit a point where nobody's buying. And that right there is where you have that zero buy, that zero flow of stocks moving higher. Now, sometimes you'll get one or two stragglers. There could be an earnings report. There could be a takeover. There could be something that significantly alters, just one or two names. But when you get down to around that zero level, that's where you want to be contrarian. That's where you want to look for an opportunity to potentially go to the upside, or maybe even stay short duration looking for some sort of reversal. That's what we got on March 12th. And we moved up, and we're specifically paying very close attention after that type of move to where we hover around that 20-day moving average. And then what we have seen is a dump back into the abyss before we see insiders step in and buy. And then we see some sort of policy accommodation, and then the markets will move higher. So we've had a pretty strong little move to the downside that transpired last week. We pushed up above that 20. I do just simply recommend that you note, pay very close attention to this 20-day moving average over the next 24 hours. If we continue to burn down, your next target is actually going to be that 50-day EMA. And that is a cheap trade to make, over the next 2 to 3 weeks. Just look short duration and take a shot to the downside in case we get one of the, a handful of 1%, 2% days, simply because of exhaustion in the momentum side, and the fact that this little like check mark, this kind of short squeeze behavior has traditionally led to lower lows. And we've seen this happen a couple of times, obviously, in the last couple of months. What we don't know is if this is a severe event, something significant going on, or if it's just capital rotation, or if it's just, broader risk off ahead of September. Because again, as we know, September is not the greatest month of the year for the markets. Bad time last year. Not a huge move down, but I believe it's about a 1% annual downturn going back to 1928. August, typically a period of increased volatility, but as we've noted before, nothing great happens under the 20 and 50-day moving average. So just be cautious and note that, these types of little squeeze moves, trap moves, will pull you back before ultimately we see that kind of flush out. So just be agile and pay very close attention, because as we see, right, this is the gilt crisis. You have these periods of zero bid, and that is specifically where we get these short squeeze moves. That's where we see all those stocks on highshortinterest.com start to rally, and then funds will use any short-term pressure, particularly above that 20-day moving average, where maybe some algos will step back into the market. They will trade and sell, and then we get into this scenario where they have been selling here. Algos or pattern traders may sell here, and then you move lower. So we are in the thick of it. It is August. It is a tricky time to manage. And if you are somebody who is looking to go to the downside on the market, then we pull up our trading view screeners. And as I've noted, pretty simple way, just tracking momentum, focusing on things that can potentially get weaker. We look at the stocks that are breaking out that meet the very specific conditions that we're looking for in terms of the EMA, the RSI, the MFI. Remember, the RSI is the relative strength index. The MFI is the money flow index, which is price and volume, where the relative strength index is a price oscillator. MACD is a short term trend analysis. The DMI, which is the ADX, which is our strength of trend analysis. We want to keep our market capitalization elevated. I typically stay above 500 million, but for the purposes of the screeners, we are just going to be paying attention to them. And then we can flip it around to the other side. What's breaking under those key levels? Well, you're seeing Apple down there. You're seeing Disney down there. And Apple is compelling right now because, well, it is such a significant component of the broader market. Breaking down here, this will go, and this can go pretty far in the event of a negative move on NVIDIA. But keep this in mind. We are oversold on the ULT at the moment. We're going to pay very close attention to this histogram and see if that closes. And then if Apple can get back above its 20 and its 50, might be a nice little trade, simple trade to the upside for the end of the week. But no move yet. Don't panic. Don't make any big moves. Don't look them in the eyes. Disney, same thing, moving down. And this is an interesting one because Disney can and will move very quickly to the downside when people get exhausted from it. So, what I'm always looking for, particularly in this environment, is you had a very tight move here between the 20 and the 50. We get down to 116, target here is 108, right off the bat, right to the downside. And it's a pretty simple and easy short. Remember, communication stocks, services, the sector is negative. The index is still above its 20-day, but communication services with Disney, you get a breakdown here. You start to see people dumping communication stocks. You got a nice little window here, right? You keep a tight stop here, right at that 50-day, and then you sell a put down here at 108, go out maybe 2 weeks, and you use this put right here as a cushion to the upside just to keep your stop very tight. But again, we got to keep a very close eye on the behavior of the S&P 500 over the next couple of days. If the S&P 500 momentum and selling continues to pick up, that would be a situation for short side traders to take action. Coinbase is just breaking down. Not very pretty situation here. But again, you see the move off that 441 downside target, probably in the 260s. Oof, not a thing that I like to trade. I tend to stay away from a lot of this stuff. MGM's in there as well. MGM continuing to break down, and that is a natural starting point for targeting a short stop, a short stock. This, the $35 put, and looking out maybe to the 15th, if this continued breakdown transpires, you could see this thing goes, and it can go very, very quickly with a lot of focus and a lot of concern around consumer cyclicals and spending and other broader parts of the economy. Just simply because, remember, I have said at the beginning of this that I don't believe that the market is forward facing on the economy in 6 to 12 weeks, a month. I think it's more focused on liquidity. The reality is that narrative drives things, and narrative drives price. So liquidity expectations may remain strong or even stable. But at the end of the day, if momentum is breaking down, it doesn't necessarily seem to be necessarily correlated to a liquidity event. It obviously is built on the back of the bull and bear sentiment of what is going to happen to the U.S. consumer in the next 6 months. But once again, if liquidity is ample and capital is ample, it will flow into risk assets, and that even includes, of course, MGM. On the weak side, what else we got? MN. Wow, this thing's back. This thing's still around. I forgot about that. Wow, that's a mushroom company. Mind medicine. Something like that. Zebra's breaking down too. That's a communication company. Oof, that hurts. That's an ugly one. And that's moving into, yeah, that's going to probably continue to break down. 28 times earnings. Hey, they're making money. Good for them. Couldn't tell you what they do. All right. MGM, low volume. So, yeah, we don't have Mr. Bierman right now. He'll be back. Don't worry. He'll find it. We'll find him. We should have sent a camera crew to locate him. All right. So, a little bit of a update on this insider buying. One of the reasons why I think it is a very good opportunity to be cautious about what had happened. And I know that a lot of, we talked to Blake this morning, Blake talking about how he, viewed that as a trap, what happened yesterday. I'll look at AIG in a second. What I said was you got to keep an eye on insider buying, particularly after the move lower on Friday. And yeah, we did see a little bit of a pop, but really you're kind of back at equilibrium when we go back to October of 2024. You see the two big spikes that are on this page. That is December of 2024 when we had a sell-off around the triple witching of the Q4. And then you see this uptick right here, insider buying. That's obviously back when the president of the United States called off Liberation Day. This did not break out. We did not get a significant amount of insider buying on Friday. Now, we still have another 24 hours before some of these things come in, but it has not been that significant. And it's actually pretty interesting to see that because, once again, the insider buys, the significant buys, or the screener that we can look at, if we pull up the screener, you're going to see, obviously, a big purchase here on Sirius XM Holdings. That's Berkshire Hathaway. You're starting to see some big purchases, but they're in the biotech space primarily. Imagine Bio. We're seeing Prime Medicine and Laramir Therapeutics. I don't know anything about these names, and I don't know if there is some catalyst that is coming up. But here's some fun things, right? We're going to go over to Market Chameleon. We're going to pull up their biotech screener. So what we're looking for here, biotech stock catalysts. So what we're going to look at in this situation is to get an understanding of what these insider purchases are around healthcare. And what we're going to see is if there is any type of, purchases or flow ahead of a major announcement or in the wake of a major announcement. So if we look specifically at healthcare, show the most significant purchases. We have a $30 million purchase, first big purchase of this stock going all the way back to midpoint of 2024. Indirect purchase, which is interesting. Acquired stock, James Flynn. Now, Deerfield Management coming in and buying this. Is there any significant event coming up with this company? Well, that's the entire premise here. And the answer is no. So I'm not going to be focused on that one. I'm going to move on to the next one. And the next one is Prime Medicine, PRME. Anything significant out of them? And I know that they're not actually a biotech company. So we move on. We just pay very close attention and see if any of these names have anything coming up. IMA. Nope. Obio? Come on, give us one. MRAI. No. All right. Well, that's frustrating. Let's see what the potential catalysts are coming up for biotech stocks. AZN, clinical trial, AstraZeneca, LENZ, clinical phase 3 coming up. And you can see on this that there are some notes. Certainly a lot of open interest around some of these very specific events. Pfizer clinical trial coming up 8th, 413,000 in open interest. BMY, Bristol Myers Squibb, expiration date for the 15th, up at 161. And these are the implied moves associated with these stocks. It's always interesting just to pay very close attention to some of the fund flow because you never know what people may know or not know. But I'm specifically always looking for a CEO or a CFO purchase on biotech ahead of some sort of event, and we're just not seeing it. So we will try again. Oh, there we go. What do we got? NVCR, Novocure. CFO bought $213,000 in the stock on July 29th. And what's coming up? A single arm trial of tumor treating fields in combination with whatever that word is and whatever those words are. And you're seeing implied move expectations of 17% for when this breaks, for when this completion date is, and other trials coming up as well. So I'm not a biotech person, but I can play one on TV. And I'm just going to be paying very close attention to what the price movement of this looks like coming off the backside. That must have been some sort of trial event. It's earnings. So the executive bought after earnings, CEO bought after earnings, and now you have these multiple catalysts coming up. That's interesting. And that's the first insider buy on the company since 2021. AUPH, clinical trial, you got two. We got one in 2026 and one in November 2026. But look at that, implied move, 45%. Hey now, pretty wild. AIG looks like it's going to 65. I'm telling you, I don't know what it is, but something's off. Something's off. And I can't figure out what it is just yet. I was on with Josh Brown yesterday and we were talking about this. I said, it was a year ago yesterday that the Nikkei crash happened and we don't talk about it. We still don't talk about it. So, yeah, that's a thing. Here you are, but that's it right there. That's the iShares JPX. And look at how this thing just rebounded straight up. All because they just said, you know what, everybody, we're just gonna hold on. So, all right. Any questions? Anything that people would like me to dive into? Because there are days where I just simply run out of things to talk about, and I can look at screens all day. But 13D filings, Wells Fargo buying a bunch of PIMCO, PEO, Charter, a lot of Charter moves in the last week and a half. And, in kind of this environment that we're in right now, if I go to TradingView, trying to pay very close attention to a setup to see whether or not we're going to get any sort of reversal today. I need to add the Bollinger Bands are there. So bounced off here. We have just sold off. Had a very short move there and we dumped right away. Wow. 9 minutes later. Outside the second band, outside the Bollinger Band, outside the third deviation. And we just dumped. And once again, as I've said time and time again, it's not very bullish when you see a lot of selling right around that standard deviation line, because that is just letting it go. And now the question is, can we set up for another trade in a little bit? PFE outlook. Yeah. Pfizer. see. Sentiment bullish. Option delta volume at 160. Earnings, BMO, company event on the 8th. Lower. Okay, so nice pop. Well, there's your line in the sand, right? So coming off of today, you've got an RSI and an RSI near 50. You got your histogram bleeding, getting tighter, and you got an ADX that's looking a lot cleaner. So Pfizer's interesting from a trading perspective because you probably, let's take a look at where you are in the standard deviation lines. Oh, you're right back at volume weighted average price for today. I mean, I would like to see one more positive day for this, and then I'd do a call spread between the 24 and the 26, and I would use that as downside defense. Still short the Qs or long SQQQ. Yeah, it's a cool Market Chameleon's an interesting platform. It's got a lot of toys, but it's also got a lot of stuff that I wonder like how do you even use it? Because they've got this stuff with like zero date option straddles. Oh, it's like I guess. I guess. Um, I mean that's a lot. Um, but they've got a it's got a good screener for analyzing what the what the premium is and what the premium should be, you know, like based on like a pure um uh, Scholes formula. Energy's breaking down. There's a lot of options on options. Like, where do you even start? What do you do? Where do you put your feet? Implied volatility rankings, I think, is probably one of your more important things, obviously. So, um, but again, I don't, I still kind of bang my head against it when I'm thinking like, how is it over 100? So I don't really go too deep on it. I guess it's open interest percentage rank that you got to be paying attention to. But um, there you go. There's your rank. There's your IV percentage rank. That's what I was looking for. So yeah. Oh, look, grinder, 99th percentile. How about that? Look at you. You shot. So once again, um, you know, okay. So once again, for those who don't know, implied volatility rank, and I mean, you should be using. I think you should be using 52 week, but basically, implied volatility rank is the measure of your current implied volatility versus the range. So in this case, it's telling you the IV for the last 30 weeks or 30 values, daily values for the last year. Um, and right, so last week's right now, so the IV rank is your current implied volatility minus your implied volatility low. Then you take your implied volatility high minus your implied volatility low, and then you take the first equation and divide it by the other, and then you multiply it by 100. So your current IV is your current implied volatility, and you're elevated here, right? So this means it's the highest it's been in that period. If it's at 0, it means it's the lowest it's been in the year. And if it's at 50, well, you're right in the mid range, right? So why it matters. So this is where in this environment where you have these elevated periods, this is the Tom Sosnoff school of selling premium. Um, you look for the high implied volatility rank and you sell that premium and you go out of the money pretty far. You look for an extraordinarily high probability spread and you do that over and over and over and over again. Now, the one thing that I will say about a strategy like this is that you have to be very aware of the thing that you're trading. Now, some people disagree with that, but I'm going to argue over and over again. I don't want to be trading and selling spreads, no matter where the hell it is, on a meme stock. I don't want to stop myself. I don't want to be trying to do it on any of these names like Kohl's, anything with high short interest. I'm going to be very, very, very cautious about that. But the point of this is that when the implied volatility is high, right, the estimate is high, it means that the premiums are very rich, expensive, good for selling options, especially if you own the underlying. It's a pretty good thing to be doing as well if you own the underlying stock to sell covered calls. And then the low rank is when option premiums are cheap, so it's better for buying options. And you're going to see a lot of ETFs on this. So if I just get that out of here, if there's any stock on this list, right, and I have to go through all the implied volatility rank, and I'm going to be talking about some of this stuff today as well. When I'm looking for this is I want to try to find a name that is on the verge of potentially breaking out, pushing above that 20-day moving average, having that strength, and then because the IV rank is cheap, is low, option premiums are cheap, to buy calls or to sell spreads or do a call spread, because it's not expensive compared to where we were at other periods of time. This will be on the test, Paul. Okay, very important test. eBay. So eBay, big breakout. Look at that. When you were at the options desk, referred to low price stocks as perpetual options. So effectively that the stock behaves like an option. They're probably low nominal prices. They have high beta, which means they have high implied volatility. Right. Let's look and see what KSS is right now. KSS. Yeah, Kohl's, for example. It's $11 stock. Current IV 30 up at 86, implied volatility rank in the 90s. It's not like this company's got anything really going on except for the fact that earnings are 3 weeks away. Like, these things are going to explode higher. And it's interesting in this environment. The only concern that I have with a company like Kohl's is that you sell a spread on something like this and then you wake up and it got taken private. Because remember, Kohl's had an option to sell itself at $65 and their board turned it down. But, again, selling spreads to the downside ahead of earnings might not be the worst thing in the world, unless, of course, the market implodes and then you just have to take that off. Think about it, things like Kohl's or any of these meme stocks, GME. Let's just pull them up real quick. GameStop, 0. Oof. Hello. Beyond Meat, 67. Okay. Now, Beyond Meat, $3. A lot of option volume. This is the type of stock that its implied volatility can surge in a day. It can have massive gamma movement or gamma-like movement. You pay a small amount, like an option premium, and you can get 50% return pretty quickly because, again, some of these names will rip just based entirely on short interest. But once again, when you get a pop like that, you get a squeeze like that, it's time to go to the other side, particularly when you get overbought. And we were overbought back here on July 22nd. I don't like this company. The other nice thing about that, though, right, is that there is no decay. Stocks don't expire. The out of the money calls do. A low price stock with a lot of upside potential and no expiration is a perpetual call option. Pretty good. Um, I guess the other point that I was noting was that these things are bad for option sellers because um, you're at the mercy of gamma squeezes and you have unstable IV, right? So if a company like BBY is not around anymore, I was looking for them. Where's BlackBerry? Are they alive anymore? Yeah. Oh well. You get a stock like this, you buy a call, and you're $3. You buy a call for 60 cents, and you buy the stock for you know, cheap instead. You can you could see a squeeze in the stock of triple. Um, and you can see some of these stocks outperform their own options because of vol crush after the squeeze, because of the bid ask spreads in the options. There might be relatively wide spreads, um, or you might have time decay when there are failed breakouts. So I like that. I like the idea of the stock is the option. It makes a lot of sense, and it makes sense that if you're trading some of these names, you don't need to use options. You can make a pretty good penny. And the other part about this is that if you're using these types of names and you're trading these types of names, remember you can use the mechanics of the market to exit pre-market, post-market, where you're not going to be able to do that in the option market. Cool. Yeah. Just a reminder. The thing about Coles is pushing back above its 20. That's crazy. Um, and I don't know what the news is, but certainly again we had that little tiny move off of Friday, and this is not a company anymore. This is now in the world of trying to survive. I don't know why they didn't go private. Oh, Lucid. Oh man, that thing's still around, isn't it? Lucid breaking down under that too. So that's an interesting one right here. I'm gonna look at it. I'm gonna actually look at shorting that. Can I repeat what, please? Oh, if it's on the test, I understand. What other tricks do we have up our sleeves today? Performance by industry, cash burn report. Ooh, yikes. That ain't good. That's that's a hell of a little thing, isn't it? How much months to burn out on cash? Oof. And yeah, it's all there for you. Nubaru, clean energy technology, never even heard of you. You're under a month till you burn out. Somebody's trying to save safe and green. That's a cool little chart. Looking for companies running out of money. Mm. And of course, they're all down at the $5, $6 level anyway. That's a fun one, especially in this environment with elevated interest rates and a lot of concerns about capital. The thing about this though is it's always important to note Mullen Automotive, 6 cents. Oh my God, remember that thing? Holy cow. Yeah, they're done. They blew up, didn't they? They're gone. Yikes. I don't think I have the chart. I don't think there's a chart for that. Is there a chart for this? Summary? Let's see. There's not even a. Oh, wait. Historical? Ugh. Yeah, that's not good. There's a split adjusted 400. Wait a minute. What? Split adjusted. The stock was 48,611,996 in August 2024. And now it is split adjusted 7 cents. Okay. So I think we stumbled into something that may be broken. Um, All right. So, uh, I gotta get that. I gotta get that away from me. All right. Gap up and go. Outperforming stocks, top gainers, opening auction. Unusual stock volume. So I will. For those of you who know the way that we are always focusing on volume weighted average price and looking for intraday movements, the simple kind of thing here is that we're always looking for is you have these deviation lines over at TradingView, and I've done this with I started to educate people on volume weighted average price because I wanted them to see the deviation lines and the way that stocks moved, right? The reality is, though, that if you are an intraday trader and you are a person who doesn't want to focus on the SPY and wants to be a little bit more agile and active, just pull up the stocks that have much higher volume than usual. And you will be looking for the names that are, you're going to see a lot of breakout names, but if they have a lot of volume that day, what is interesting and unique about them in a company like STAA, right, that's going to be reporting earnings tomorrow, is this company opened at the bell and it has effectively had a huge gap up this morning. You have seen with this name 12-cent spread, not good enough. What I'm looking for is a name where the stock is chopping and bouncing or just ripping higher at the opening bell. We didn't get it here. You just got to bounce around and look for names. AGL. Because what you're looking for is companies that are just very, very active that day. And if they break above volume weighted average price, you buy it here and you're just looking for the burn for the rest of the day. So 82 cents took you up to 92. Nothing too exciting about that. But just OTRK. These are all things that may have gapped up in the morning. On track. Well, there you go. Perfect example. So on tracks had a lot of volume. This is very cheap stock, but at the end of the day, what you're looking for, just these moves above volume weighted average price. As long as you're above this volume weighted average price, you can exit at any time. Just buy at the blue line, sell at the blue line in the ascending pattern. I know that there are now SPACs coming from, why not, Mr. Trump, or SPACs. They're going to cut down on SPAC oversight. Why not? It's going to be an absolute treasure chest of just anything goes for a while. Lemonade, LMND. Yeah, so pre-market pops up 41 to 49, and then back in it, back at the VWAP. All right. My masterminds are about an hour, but we have done others that have gone up to 90 minutes. Last Wednesday, we did a special one, and it went an hour and 15 minutes. All right. What about unit January call? Yikes. What's your question, Cheaton? Like, what's going on with it? Like, what type of volume we're seeing? Yep. Yep. So you're at, here's the thing. And this is one of those things where I talk about this tool. Um, they have, their own Theo value tool of what the theoretical value of that option should be based on their own inputs. This is saying it should be 17 cents, and it's currently trading. The ask is currently at 35. So, that's it's a pretty interesting little tool here because they're constantly looking for that mismatch. Um, oh, forgive me, 27 and 50. Yikes. Wow. Okay. Well, how's about that? Bullish. That's weird. Man, they're behind on that. That's not a bullish crossover. That's a missile launch to the downside. What happened? Earnings, revenue lag estimates. Um, yeah, that's a breakdown right there. You got some more downside here. This hasn't even crossed over on the 50. It's barely there. 30 minutes, you're oversold. So you might be looking for a pop here. A little bit of a pop. But I mean, this doesn't look too great. Real estate too. It's interesting. Huh. All right, 1227. Pay very close attention to the futures. Cocoa, 4%. Coffee, killing it. Wheat down, Bitcoin down, and once again, paying very close attention to the energy side and the VIX. So, key things for today. Interesting session, but nonetheless, 20-day moving average on the FNGD is an important line in the sand. It's that 50-day that we have to be worried if there's something really bad going on. Keep your eye on the Russell, which is now bouncing back to 220. Still under the 20-day moving average. Not trying to force anything at this point. And this is one of those days where it makes a lot more sense just to keep your eye on what happens when you have these sell-offs. What happens down here? You get these reversions, you get these pushes back, and the markets do not go straight down. They are lower highs and lower lows. And we're trying to see whether or not this Russell is going to hold in channel. Yeah. 218 will be the thing. Brandon's going to talk skew, which is what we need. We need some skew. Tricky times. Very tricky times. He's coming in. All right. Oh, that's not nice. Don't say that to Brandon. He didn't do anything. Lower highs, lower lows. Watch this period heading into the end of the day because this short-term period, after the type of selling that we saw the start this morning, these are the types of short-term moves where funds will sell back into that buying pressure just because they can. S&P 500 volume right on cue. Brandon, come on in. You and you and you and you.
How are we doing, Garrett?
I'm good. Just trying to make some sense of this market today and just kind of a quiet, you get that selling to start today and then you just get covering. It's nothing really.
Not a ton going on. I mean, again, I had a little sad to do, but early on, I mean, in the options market, I mean, just not a lot of big trades today so far. I mean, again, I haven't looked in like the last hour, but it's quiet, and I don't think that's good.
No, quiet's never good. All right, well, I'm going to let you take it over from here.
All right.
Hope you're having a good day.
Hey, we'll see. Have a good one.
All right, take care.
All right, folks, we're going to talk skew a little bit today because again, I got a blog post I did a while back. It will help us a little bit in this.